Once what Wall Street calls shareholder value was considered outright manipulation and punished as fraud. Today, stock buybacks have become a dominant force that lifts markets, boosts executive pay, and enriches shareholders without creating anything new. So how did a former crime become a pillar of modern capitalism? In the 1920s, markets behaved like casinos, where executives manipulated prices and illusions fueled fortunes. When the 1929 crash hit, companies propping up their stocks with buybacks helped accelerate the collapse. By 1933, trust in capitalism had shattered as factories closed, banks failed, and unemployment exploded. FDR responded by rewriting the rules of capitalism and banning stock manipulation through the SEC. 4. The next 50 years, buybacks were effectively illegal because the market was meant to reflect value, not vanity. During this era, companies grew by reinvesting in workers, factories, and innovation, rather than manipulating stock prices. Then, in the 1970s, economists like Milton Friedman claimed a company's only duty was maximizing shareholder value. By the 1980s, Reagan-era deregulation aligned perfectly with this philosophy and pushed corporations to prioritize stock prices. In 1982, SEC Rule 10b-18 quietly legalized buybacks as long as companies stayed within broad daily limits. This single rule transformed corporate behavior and opened the door to legalize stock price manipulation. Buybacks surged from rare events into routine practice, eventually becoming a $1 trillion annual habit. Reducing shares made earnings per share rise even without real growth, creating profit through optics instead of innovation. Buybacks became corporate plastic surgery, appearance over substance, and Wall Street rewarded the illusion. By the 1990s, tech companies used buybacks to offset stock-based compensation and inflate executive pay. After the 2008 crisis, corporations used profits and borrowed money to repurchase shares even after taxpayer bailouts. Between 2009 and 2019, the top 500 companies spent over $6 trillion on buybacks, more than on actual investment. Buybacks created the illusion of health while making companies more fragile beneath the surface. Despite criticism, Wall Street defended buybacks because a system obsessed with stock prices prioritizes appearance. Corporate success shifted from building real value to reducing shares and inflating charts. Governments also embraced rising markets as symbols of stability and political success. The illusion held because people believed high stock prices meant a healthy economy. Supporters argued buybacks were efficient, but in practice, they hollowed out companies and prioritized payouts over resilience. Research slowed, wages stagnated, productivity stalled while executives became richer through stock-linked bonuses. Legalized manipulation became the norm, not the exception, and shaped the modern financial system. By 2018, companies spent more on buybacks than on capital investment, turning entire industries into stock management machines. The 2008 crisis should have ended the cycle, but bailouts and cheap money supercharged it instead. Between 2010 and 2020, companies spent over $7 trillion on buybacks, enriching the wealthiest while workers fell behind. The pandemic exposed how leveraged and fragile businesses had become after years of self-inflicted financial engineering. Buybacks evolved into an ideology that rewarded extraction over creation and efficiency over endurance. They drastically fueled inequality because only those who owned significant stock benefited from constant repurchases. As inequality grew, companies doubled down by borrowing even more to prop up stock prices. Debt soared. Profits looked artificially endless, and recycling money replaced real productive growth. Market manipulation became embedded in policy because governments now depend on high stock prices for stability. The system drifted into a dangerous illusion sustained by belief rather than real economic strength. History mirrors the 1920s, with cheap money, inflated stocks, and blind faith in endless growth. When appearances replace productivity and capital concentrates among the few, collapse becomes inevitable.
Buybacks signaled not strength, but corporate abandonment of long-term investment in favor of short-term profit.
The same mechanism that once fueled disaster is now celebrated as efficiency, repeating an old mistake. The economy has become addicted to inflated prices, creating fragile prosperity built on illusions. When the illusion breaks, the collapse will be one of trust, not innovation. Buybacks represent how power rewrites rules to benefit itself while masking decay as sophistication. The true bubble is belief, the belief that confidence can be manufactured forever. Eventually, people will stop mistaking inflated stock prices for real prosperity, and the illusion will fail. Efficiency without purpose accelerates decline, turning capitalism into choreography rather than creation. If this shifted your perspective, hit subscribe, because history shows the truth when numbers try to hide it.